Let's go over different mortgage options when buying a home. Starting at number one with the most common type, conventional mortgages. These typically require a minimum credit score of 620 with a down payment as low as 3% for first-time homebuyers or 5% if you're an existing homeowner. Avoiding private mortgage insurance requires a down payment of at least 20%, making conventional loans attractive for those seeking lower interest rates with a larger down payment. Number two, FHA loans. These are backed by the Federal Housing Administration. An FHA loan can allow you to buy a home with a credit score as low as 580 and a down payment of 3.5%. With an FHA loan, you may also be able to buy a home with a credit score as low as 500 if you bring at least 10% down. FHA loans are ideal for first-time buyers or those with modest credit history since the rates are generally better than a conventional loan. Number three, VA loans. If you've served in the military, this one's for you. VA loans offer unmatchable benefits, including zero down payment, no mortgage insurance, and some of the most competitive interest rates of any product out there. There's no minimum FICO required from the VA, so this loan is a true thank you for your service to our country. Number four, USDA loans. These are insured by the United States Department of Agriculture. USDA loans can allow you to buy a home with no money down. You must meet certain income requirements and buy a home in an eligible suburban or rural area in order to qualify for the USDA loan. It can be a little challenging finding that perfect sweet spot where it's not too far out in the middle of nowhere, but if you're okay with being in a rural area, then this might be the perfect option for you. Number five, bank statement loan. A bank statement loan is an alternative mortgage option where lenders use an applicant's bank statement rather than traditional income documentation to assess their ability to repay the loan. This type of loan is for self-employed individuals who tend to write off a significant amount of their earnings and taxes. Number six, debt service coverage ratio or DSCR loans. A DSCR loan assesses the property's ability to generate enough income to cover its debt obligations, including mortgage payments. Lenders use the DSCR metric to evaluate the property's ability to cash flow and the borrower's capacity to meet those debt payments. This makes it much easier to qualify for the home since you'd be using the property's ability to generate income to qualify. That means no pay stubs, W-2s, or taxes necessary, which makes this a great option for investors. Number seven, ITIN loans. An ITIN loan is designed for individuals who don't have a social security number, but they possess an individual taxpayer identification number issued by the IRS. These loans cater to those who may not qualify due to their immigration status and offer an alternative option for home financing. There are many options in the industry, but the seven mentioned today are the most notable in the market. If you have any questions, feel free to text me on my personal cell below.